Good morning, everyone. Very, very encouraging to see a room full of people waiting to hear passives. And I've been a part of the passive journey, I think, for the last decade or so. So I have seen the market and the space really grow out. Anita and Prem gave a really wonderful, I think, introduction to passives and how the markets have grown out. I think when I started the industry, started in this industry, I started with actives, and then I moved over to being a very passionate advocate for passives. I've seen both the space, and I think there is a need for a cohesive growth, but obviously there is a need to understand where passives form a critical part of everybody's portfolio, because I think that's the space that people are not understanding. As Prem said in his last share, if you don't take it all, aap bikhar jaoge. So let's understand that bikharna nahi hai, but sametna hai. So let's try and see how we can redefine or reimagine business models, and that's the aim of this kind of panel, and all the experts that are here are going to try and help you maybe understand why passive is important. I think because that's one of the biggest discussion points or the arguments that people have. Now, I will try to give some perspective before we kickstart this journey. So there has been this Sensex statistics that has been making the round. So just to make you understand why index investing or index-based investing is not something where you don't get returns. So in the 43 years of Sensex has given a compounded annual growth rate of 15%. That's definitely not small. And within that space, if you see a 3-year or a 5-year or a 10-year, let's see how many times it has been a positive and how many times it's been negative. So in 3 years, in a 3-year kind of history, Sensex has given 89% times positive returns, 11 negative. In the 5-year returns, 96 times positive and 4 times negative. And in 10 years, it's almost been 100% positive. So that's the kind of comfort and index investing given. Obviously, there is alpha in the space, but what about a sustained, and a dependable and a continuous stable returns? That is where your index comes in. Now, active funds, like I said, we are not doing a debate between active and passive. Active funds in the hybrid space has given 16%, diversified 16%, ELSS 18%, and other funds has been 16%. So 15.5 rounded off to 16. You are getting almost the same between active and passive, right? I have been a part of Standard & Poor's, and there was a report called S&P Index versus Active, where it's not even, just not one, it's been over 10 years that report has been coming, and consistently large cap funds have been beating the benchmark. So obviously, unless one can find with a fine tooth and comb that perfect fund that has been given, alpha over decades, which typically doesn't happen consistently, you have a task in ahead of yourself. So Prem and Anita said that, you have 9 lakh crores with 17% of the industry AUM in this space. So we definitely can't ignore this space. So let me kickstart this session with starting off with Pratik. Pratik, how can clients, how can MFDs or the distribution intermediaries, investment advisors, look beyond the standard plate and look at how they can include passives in their portfolio and ensure that it's a better risk management tool and helps their business models grow?
Thanks, Koel. Good morning, everyone. It's good to see so many people at 9:30 in the morning. So great, and thank you, Cafemutual for inviting me. The second version, and looking forward to more and more in the future. So I think coming to your question of why passive should be in a portfolio. I mean, honestly, it doesn't have to be. So I believe that. You don't have to add passives in a portfolio. I think portfolios can be purely active or purely passive. There is no right answer to that. If there are obviously advisors out there who think that they're good enough, I think they don't need to really add passive. But let's talk about how the industry has evolved. I think this made even more sense 5 years ago when there wasn't much action or activity or a lot of options in this space. But let's see how the industry has evolved. Over the last 5 years, since I've been involved in this industry, we're now obviously grown a lot. As Koel mentioned, over 17-18% of the industry is passive. In the US, more than 50% is passive, so it's growing at a very fast rate. The market share is growing at a very fast rate, so I think there's a lot more customer adoption happening in passives. So that's number one. Also, I think in terms of efficiencies, 5-6 years ago, the tracking errors of passive funds, the expense ratios of passive funds were pretty high. I would say I myself wouldn't advise MFDs to invest in passive funds 5 years ago, but since then I think we've seen a lot of efficiencies coming into the market. Talking about our own funds at Motilal Oswal, are something as simple as a Nifty 500 fund, which is a 500 stock portfolio. That has a tracking error of 0.03%. Over the last 3 years, which is really great, and obviously not only me, but most AMCs who are running passive funds have become very efficient. So they've become a lot more investable. They are grown a lot over the years. Apart from that, in terms of performance also, what we've seen is that, as Koel mentioned, large cap spaces where passives make sense a lot. Most investors tend to have a dominant part of the portfolio into large cap side, whether you're conservative or aggressive. Large caps tend to be the dominant part of most people's portfolios, and that's where I think passives shine the most in India. In fact, even outside of passives, if you look at so we have about 35 funds today, and if you look at this is 35 passive funds, and if you look at all our funds in the equity space, the funds that are underperforming the most, or not underperforming, I would say the funds that have the least performance over the last 3 to 5 years time has been Nifty 50 and Sensex. So there's a lot of options available in the market today. Passives are not limited towards Nifty and Sensex. You have broad-based indices, 100, 500, mid caps, small caps. In fact, the top returning passive, the top performing funds in the industry over the last 5 years have actually been something called factor funds, where you have something like a momentum or a value, which are extremely popular in the US. I would say the second biggest category in the world after your broad-based passive funds like your S&P 500 and Nasdaqs. So that's obviously there's a lot of merit in the product itself, and that's what I think makes sense for a lot of people to incorporate passive funds in their portfolio. From a research lens, also we've seen it, and what we've seen is adding passives to the portfolio adds a lot more. I think your performance becomes a lot more, at least in the large caps or overall portfolio, it becomes a lot more efficient. What we've seen is that if you look at, maybe having one passive fund across, many funds in the portfolio, your returns of your overall portfolio become a lot more consistent, a lot better, slightly higher. So I think, I'm happy to share this report with anyone. And lastly, it's really heartening to see so many AMCs also coming in and launching passive funds, going out there, doing education. 5 years ago, I don't know if there was any other EMC, including us, we weren't really doing a lot of stuff in passives, but today you have so many more funds. You have hundreds of funds coming in. A lot of, MFDs, RIs used to complain that there was no servicing for them for passive funds. Today, at least for Motilal Oswal, we have our own dedicated, sales team that is, only focused on making sure that, the servicing needs are being met. We have a dedicated research team to ensure that all the research needs, product needs are being met. So I think, and this obviously will, a lot of other AMCs also have obviously similar initiatives. So I think on the servicing side, on the product side, we believe that it makes sense to add passive. And just to close off, yes, I do agree that, obviously passives don't offer the same incentives. But, actually even there, we've looked at the research, we've looked at over industry trends. And what we've seen is that, a lot of the passively managed funds today, especially maybe not ETFs, but index funds, which offer a lot more simplicity over ETFs. Maybe we can have a debate. But I think, the incentives, the commissions are actually higher than industry averages. And we've studied this. We've looked at overall the entire distribution business, and we've seen that it's higher than median. And I think we expect that to continue over the next few years. So I think this is something which is, again, as I said, there needs to be more awareness on this, and hopefully, conferences such as these will help that. So that's how I would play this.
Thanks, Pratik. I agree. I think if we saw 5 years back, we wouldn't see this kind of impetus. I think COVID did bring a lot of, during COVID, I saw the passive AUMs really go up. And I think the amount of options that you have, so you don't have to stick to just Sensex or Nifty, you have a lot more options today. But you have apprehensions that, there isn't enough, I think, juice in this space. So, Ankit, going to you, there are these two big myths, and I'm going in random order. So, there are these two big myths that one, passive does not generate alpha. Alpha is the big, elephant in the room. And there's another myth that from a commercial model, it's not so viable for the distribution fraternity. So, I mean, why don't we, demystify those myths?
Good morning, everyone. And thank you, Koel, for bringing this point on the table, because actually we need to address it, and the sooner we address it, the more we can grow this market. Now, in fact, these are not the two apprehensions. There is one more apprehension, which is awareness about the passive strategies that we need to bring with our fraternity. Now, having said that, the two apprehensions that we are talking about is the first, that passives cannot generate alpha, and they are not alpha generating strategies as compared to actively managed, and that is the reason they are so popular. So, to kind of answer that, if you see, the general perception of passively managed strategies is about the broad-based indices, where the index selection or the index weighing is based on their market caps. Like there are indices called Nifty 50 or Nifty 100, or in fact Nifty Mid Cap 150, all of that. Of course, these strategies or these indices where the selection is based on the market cap, they cannot be alpha generation, because they are just replicating the stock, and the stocks are identified basis their market cap. Now, other than the market cap based indices, there are also factor based indices, where the selection of stocks are not on the basis of their market cap, but based on the factor that those stocks carry in themselves. Now, those factors can be market factors like momentum, low volatility. Those factors can be fundamental factors like quality, growth, value. And those factors can have additional layer of market cap. For example, there are momentums based on large and mid cap. There are momentums based on mid cap. There are momentum based on small cap. So they are slicing and dicing across the parameters of the market cap. Now, these are called smart beta strategies. And if you analyze the data, these smart beta strategies have tendencies to generate significant alpha over broad indices. At the same time, they are also not generating a very different standard deviation, because return is not the only parameter that we should talk about. Risk is equally important. So even on a risk-adjusted basis, if you compare data, all these factor-based indices generate phenomenal risk-adjusted return as compared to broad indices. So in fact, alpha is not a challenge. This is an area, or smart beta or factor-based strategies is an area which is actually lying in a sweet spot between actively managed and passively managed, in which you are actually using a disciplined investment approach without any discretion. At the same time, they're also generating alpha for you. So alpha generation is not a challenge. Now, coming to the second point, if you're talking from a commercial perspective, or if we straight away talk about brokerages, now let me just put it in numbers. That in case of market cap based products, yes, the commercials are low, the brokerages are low, because if you see, the TERs are also low. But when it comes to factor based or smart beta strategies, the expenses are on the higher range, close to 1% normally in case of factor based indices. And the brokerages there are also very attractive, close to 50-55 basis points. Now, if you compare it with actively managed strategies, you may think that yes, it is low, because in a general parlance, what we hear is that on an average, the brokerages in case of actively managed strategies is around 1%, whereas here we are offering 50-55 basis points. That's one point. But if you see from a different angle, you are actually putting something different in the plate. There is a different flavor. With non-discretionary selection allocation, you are bringing alpha to the table, which means you are adding in the investor's portfolio with a low cost offering an alpha generating product. So that's one part. Secondly, if you see, all the actively managed strategies in their expense structure has to follow a slab. So as and when the AUMs will start growing, AUMs will grow at a certain level, your expenses will have to come down. And ultimately that will have an impact on the brokerage also. Whereas in case of index funds, particularly does not follow any slab. There is a hardcore limit of 1% that we can charge. So despite my AUM 5,000, 20,000, 25,000, 50,000 crores, the expense structure and the brokerages will remain same, provided regulator sometimes intervene and do a slicing there. So from both these aspects of alpha generation and commercials, I think passive strategies makes a very viable option for investors. In fact, these are the strategies where there is in for everyone. It is a win-win situation for everyone. From a distribution perspective or from a distributor perspective, if you are adding these factors, you are actually innovating with your portfolio creation abilities or with your distribution abilities, because these are new offerings and everybody wants something new in this trend. नया क्या है वो बताओ. So ये बहुत बड़ा नया space है एक. Lot of factors keeps on coming. So if I talk about factor-based indices in last 3 years, the CAGR growth of these factor-based products, be ETF or index fund, is significant, from close to 500 crore to now to close to 15,000 crores, which means people have also shown interest into this, despite the low brokerages or the narration that there is no alpha. So having said that, if you see, these aspects are very well addressed. Now, as an AMC, as an investment managers, we also own this kind of objective, is that we should educate everyone, we should make people aware that yes, there is a strategy which has its own inherent advantage, and that can be added to the investor's portfolio in the best interest of everyone.
Yeah. Thanks, Ankit. So what I'm hearing is, beyond your standard, market beta. Market beta is nothing but your market returns based, product. You have smart beta, and what's smart beta? It's nothing but factor based. So a lot of the formulas, that active managers sometimes use, you kind of create that formula into a standard index rule. You create that index, and then that becomes your smart beta product, because the whole idea of index investing is that you're following the index, right? So obviously, what we are hearing is, while active has its own palette, you have a separate kind of offerings that passives offer you. Like today's Akshaya Tritiya, I know a lot of people like to buy gold and silver, and from an active perspective, if you want to really go and access that, yeah, I can go to a shop and buy jewelry, but why not I buy a gold or a silver ETF, because I'm directly dipping into that gold or silver price. And that is, that differential option that, we have. But, going to you, Umesh, since we kickstarted on the smart beta, etc., can you also see, as the product offerings are expanding, how can, the intermediary, kind of use, or this network use it to their advantage to offer more to their clients?
Yeah. Thanks, Koel. Thanks to Cafemutual for inviting me here. So I think both the speakers talk about the one thing which is common about smart beta, and I think that is where things are moving on. When we talk about innovation, we have seen that nowadays investor has a lot of information which he used to have 5 years back. So now the information flow is very high. From an investor perspective, in some cases it is from a third party, in some cases the advisors are also fueling them those kind of information, and that leads to something new, which Pratik also said and Ankit said, that what's new. The new thing is something where investor wants, and that is where the innovation is coming up in the picture. Now, if we talk about when this categorization came in, then there's hardly any scope for innovation on the active side. Now, the innovation which lies in passive now, and I think that's why now more and more AMCs are, gearing up for more and more passive products, starting from a plain vanilla Nifty 50 or Next 50 or mid cap to a innovation product like a global fund or a smart beta. As Pratik said, that 500 kind of products are being managed at 3 basis point. Now imagine that 3 or 4 basis point, 5 basis point kind of expense ratio for an investor. Like if he is not getting the alpha which he is targeting to, and I think he has all the rights to look at for other options. Now the smart beta is something which is a step further. Now there is a discussion that active passive. Now I must say, when I say smart beta, it is actively passive, because smart beta is active within the passive. So from that perspective, we can say we can create and we can launch or we can buy a product which can give alpha to an investor over and above the plain vanilla parent index if you create a separate index. Now, just to correct you, Ankit said 15,000 crore, but right now the AUM of smart beta category is 18,400 crore. So it has grown significantly in last 3-4 years, and I see the kind of flows which we are seeing, and predominantly is momentum and equal weight. There are two categories where we have seen a lot of flows coming in, but other factors also, because we have to keep in mind that every factor has a cycle, because the market has a cycle. So an investor should keep that cycle in mind, that in a bull market your momentum or alpha strategy will do very well. In a bear market your quality strategy will do well. In a recovery market your value strategy might do well. So there are different cycles for there are different kind of factors. So we are trying at a AMC level, at a manufacturer level, we are trying to create such products which can complement your client's portfolio, which can give them assurance, okay, this kind of market scenario is there, and how you can navigate through that market cycle from that particular factor. Now, this is something, Ron, it is not restricted to smart beta. You have debt products also at this kind of scenario where we know that interest rates are going to go down at a modified duration of 6. If you expect a 50 basis point of cut, there are very high chances you can end up getting 3% kind of returns, which is if 6.5 is a coupon, so we can easily end up getting 9.5. So yeah, passives can be used for a shorter duration also. Passives can be used for a long-term horizons also, be it a smart beta, be it a plain vanilla, be it your debt products or a theme. So this is something which is growing, and I think at a MFD level also. Right now, if I look at the overall AUM of MFDs, around 13.55 lakh crore, with around 1,23,341 MFDs are there. Out of which, if that segment is having almost 3% of their AUM shifted towards passive fund. And that is what the shift is happening, which was not there, say 3-4 years back. Now, if I segregate it more, and if I move to advisors who has more than 500 crores of AUM, there are around 250 plus MFDs are there. They have more than 5% of their AUM allocated towards passive. So this number is changing slowly and gradually. That is primarily because of innovation, which I'm sure the passive can provide. And going ahead, we can see lot many things or lot many ideas like this. I'm sure we, as a manufacturer, our job is to make sure that we come out with something unique at a right time, so that it can complement your client's portfolio. So ideas are so many, and you can see in future lot many will come back.
Yeah. Thanks, Umesh. So what I'm hearing is, innovation, growth, and, an expanse in terms of offerings and in terms of investor growth. Now, we have investor growth across institutional and retail, which is very, very common among the passive space. But another space which is actively developing is the high net worth space. And I think, Alok, coming to you, you have some experience with that space. So I will now, kind of pick your brain on how that landscape has changed, because definitely mutual funds, we are seeing that growth coming in. But what I hear from, rumor mills and conversations is that there's a huge amount of, AUM shift that's happening, and, a kind of a positive outlook on passives by the high net worth, where they are also allocating around 5 to 10% odd in the passive space. I'm not saying that it's a huge shift. Of course, there's an active, bias, but that confidence on passives is growing. So what's your experience been?
Good morning, all. Thank you, Cafemutual, for inviting me. I think I'm the only odd man out, and that's why Koel has asked this question to me. I represent the super active side. So I represent the alternate side of the business, where PMS and AIFs are offered to HNI investors. Now, coming back to this question, I take a pause. Let's say, as an individual, everyone has some basic needs and wants in their life. What you do, you need a balance between these two. Same analogy you can draw to investment sides also. Sure. So every investor has a basic need to fulfill his life goals. through optimal investments, which can be fulfilled with products who can give them market-linked returns. At the same time, their want is to maximize their wealth, which can be fulfilled with the active side of the business, which is your active mutual funds and other stuff. Coming back to MFDs, MFDs, how they can play a role to it. MFDs normally work not on the remuneration basis, but they work more as a life partner or coach who constantly nudges the client how to achieve their life goals and maximize their wealth, both the sides. And if you include only active, you are basically risking your business model, because active funds will require two things. From the investor side, they require conviction and patience for a very long period to bear the fruits of outperformance over a sustained period. At the same time, it also requires fund managers, their skill sets to continuously outperform and beat the markets. Possible in all circumstances. It may be true in some bull markets or in some phases. But if you take and go back to passive side, it will deliver you market-linked returns, whether it is bear phase, bull phase, consolidation phase, or any time horizon, whether it is near, medium, or long term. If you include passives as well as active both in your business model, obviously it will have some benefit for the clients. It will lead to even higher AUM and higher revenue drivers for you, as well as better client retention and client happiness. One happy client can give you even more referral opportunities also. Coming back to like Ankit and others explained about smart beta strategies and all. Let us take mutual fund side. Active funds, fund categories have become more commoditized. The differentiation scope is very less. And when if you go to any HNI or even a small investor who has started with a low base, after a certain period of time, he graduates to a high base. At that time, he looks forward for differentiated or innovative products and solutions. Because of commoditization in active categories, it is very difficult to create differentiation or innovation. That's what Ankit and Umesh also dwelled upon. So there, you can slice and dice the various product categories. You can create smart beta strategies. All these things can play, and it will have a rub-off effect on your own AUM, and ultimately, obviously, there will be some cost consciousness, but it will lead to higher revenue, which will much more compensate than the loss of revenue on per unit economics basis. So that is, in my opinion, active will remain, but passive will also play a big role. If you have to draw down on client satisfaction, better client retention for a long term, because you want a symbiotic relationship with your investors, which has to be a long term. So you have to play a balance between active and passive both, and that is what I can think of at this moment. Just take Indian scenario also. 10 years back, how many passive funds were there? In my previous company, we had launched one mid-cap index fund. There were no takers. Today, because of awareness, push from regulators, push from, and even client consciousness on cost and other stuff, and even recent studies which are showing that there has been underperformance in active funds, the market is automatically moving to the next direction. This is already happening. You can't avoid that. So obviously, you have to adapt yourself to the new realities. And you have to bring a balance of both when you are in your offering to the clients.
Thanks, Alok. This is complete music to my ears, because like I said, a couple of years back, we wouldn't be listening to these kind of reiteration of why passive is important, why it should form a real, a critical part of your portfolio. But, if I had to summarize, we are looking at it's not the debate between active or passive. It's having a cohesive relationship. Coming to you, Ashish, you've had a considerable experience in the markets, seen them grow out. And your focus also as a model has been more towards client servicing and ensuring that the client is taken care of rather than only focusing on the business commercials. So how have you seen the landscape, and how has passive now transformed the way advice is being given?
Good morning. See, I myself was an investor in Junior Bees somewhere in an NF of Junior Bees, where I subscribed with 20 lakhs rupees of my own capital. See, 2003. See, that I'm using this indexing and ETFs. See, in MFDs, there is one is indexing. Indexing means we are making investment into the market as a very simplicity. We are removing the fund manager risk, something like processes and all. I think that is the way I understand indexing. But what has happened in last couple of years, or in India from evolution, I am associated with the index funds. There are two parts. One is the index fund like a FIF form, and second is the ETFs. May I ask this MFD, how many MFDs have BSE or NSE terminal with them? Please raise the hand.
No, you're right.
I mean, whether you have access of your client to buy ETFs? Very few. And this answers, Koel, this is the problem. We are talking NASDAQ ETF, we are talking Hong Kong ETFs, and the people who are sitting here did not have access to it, and we are talking everything on the index fund. I think this is the biggest problem. Because the MFDs, I have also had MFDs in 96. We are easy to fill the forms and all and take the whatever MFU we use or whatever things. But ETFs is a totally different animal for the MFDs. Because they don't have the access to it, obviously the MFD will not talk about ETFs. The fundamental flow, I go to the client, whatever family relation of the client, but I am not going to make any revenue out of it. In fact, he will ask me about what is indexing in ETFs, okay? And I say, okay, then we introduce him who has access to ETF, I will lose the client for everything. That is the biggest flow I think we as a MFD fraternity required to get out of this. And I think all of four are manufacturers, most of what I understand. And this is the biggest flow. See how we use, if you graduate a person from 100% fixed income, where India is 90% of the fixed income, even today, and we talk about the equity is a long way to go. If you to graduate from 100% fixed income fellow to the equity market, I think we should use large cap passive fund. कि भैया आपको 8-9% अभी तो एफडी में 9% भी नहीं मिल रहा है, कि आपको एटलीस्ट 10-11-12% मिलेगा 10 साल में, तो आपका कैपिटल लॉस है ही समथिंग लाइक दैट. नाउ व्हाट हैज हैपेंड? आई एम नॉट अगेंस्ट स्मार्ट मीटर और एनीथिंग. वी हैव मेड दिस स्पेस आल्सो कॉम्प्लिकेटेड. 35 फंड्स फ्रॉम यू. हाउ मेनी फंड्स यू लॉन्च? नाउ एमएफडी क्या करेगा बॉस? आर वी मेकिंग अवर लाइफ सिंपल? आर वी अचीविंग द ऑब्जेक्ट ऑफ इंडेक्सिंग? आई एम आस्किंग ऑल ऑफ यू. जैसे एमएफडी बोलता है भैया अपने को तो जो फंड है ना, क्लाइंट इज हैप्पी विथ मी, एक्टिव अंडर परफॉर्म करेगा, समझा देंगे, 3 महीने के बाद फिर से कर देंगे. दैट्स द वे इज हैपनिंग. Today, whatever size of our indexing we show is the government is putting money to index fund. We should not pat ourselves. Let us be very honest of it. Am I right? It is the government. See, government is ahead of me and you. Let us, I am not any government, because in a last party government, they initiated the EPFO to put the 5% to 15% money into the market. This government implemented it. And that money is flowing into the ETFs. Why retail money is not coming? Because we have made this space complicated. That is my way of looking. The 110,000, who said some number of MFD, you said, out of that I think 100 doesn't have the access to the ETF market. How will they say ETFs? I think this is an operational angle. We need to sit together and find out the solution of it. Now, and we have to make very few simple products of passive. Now tell me why we are making, see, we say, where you go to the client, I don't have to talk about the underperformers or overperformer. But at the same time, we are creating smart beta to create the alpha. It means, see, I think, I'm very open. Let me tell you whether this is the right thing when I sit in my office or 24/7. Why? Because I use everything. UTI Momentum Fund, I have given huge money. This fund also underperforms. But we have the benchmark is the same. जैसा उसके benchmark को बिल्कुल देखो 3 पैसे से tracking error है. But to the Sensex or Nifty is underperforming for a couple of quarters because we don't rebalance. We balance only after 3 months. Momentum will go to different direction. Am I right? So why we are doing this? Suppose we have to equity is an asset class. It is underpenetrated. There is a huge thing. So I think, and indexing, I believe in, as I told you, 2003 or 4, I am the first investor into junior Bs. Okay? But we have to make things very simple and clarity about ETFs and index fund. That bridge has to be gap. I think that's the we can make it for us. And third and last, why this in US and UK? This is again I am thinking. What has happened? The market is over-researched or too much of research. There is very difficult scope for the active fund to create alpha. Second thing, laziness. I use the word little bit aggressively, but laziness of the active fund managers is showing the indexing has become popular. 3, we are talking of 10-year data. 15-year data, it doesn't outperform active fund. You tell me what is the average investor in India in mutual fund? SEBI data says 28 months. Investor doesn't last for more than 28 months. Why we are giving the data of 10 years, the active fund doesn't outperform, all the active fund underperform passive? We can change the active fund manager from X to Y. That's why I am paid the trail commissions. That's why I'm telling you, this is a space, simplicity. How we use, when a client, baby step, I want to take you from 100% fixed income to the equity allocation, is we said 2 or 3 index funds or mid cap index fund ले लीजिए, एक large cap ले लीजिए, खत्म हो गई. Then we graduate into the active. Then you can say PMS, and then you can have AIF and long shorts and everything comes. When the client educates, his assets educates, I think there should be a journey when you get across with the client. I think there is one thing, I am with indexing, I am with the passive funds, always we have to make life simple for the users and intermediaries. That is only my say.
Thanks, Ashish. I agree. There is a lot of, I would say, options available. If you look at active funds, we have more than 46 mutual funds. Each of them have large cap, small cap, a lot of the different kind of funds. So each of them will at least have 20-25 funds of their own. The smaller may have less. Multiply that, you have that many active funds. But the idea, Ashish ji, of having an index based is when you see an index, you can really capture what the standard balanced returns that are coming on. You can see the index returns when you go on BSE or NSE. Smart Beta was actually, I think a brainchild of that thirst for alpha within the index space, because everybody loves the word alpha, right? So I think that's where it's all come from. But, I think I would go for a final round of, wrapping up, from each of you all. But I just felt that it would be nice to maybe get some questions because, a lot of things were discussed. Let's see how much, what are the kind of queries you all have. So maybe we have another 5 minutes and I think I'll just throw that open for questions. Any questions?
Okay, can I go ahead? Alok, this question was for you. So, you mentioned that there's a certain balance that the MFDs can use for between actives and passives. So can you just explain, differentiate for a newcomer what you would recommend in the ratio between active and passives, or somebody who already has an, AUM of between 100 to 200 crores, what would be your advice for that kind of a MFD in terms of ratio between active and passives?
So let me take first for HNIs, 100 to 200 crore. As you become wealthy, you become
The
more...
question is for the MFD AUM, not the investor AUM.
Okay, sorry. So, see, as you become, basically when you graduate your business from a small base to higher base, at that time you want to de-risk your business model also. Let's say, take the latest SPY studies, where we have seen that majority of the funds active funds have underperformed in 3 or 5 year categories. You have to do lot of explaining to your clients when the active funds which you are offering have underperformed their benchmarks. Let us take, if you are having a 10 fund basket which you are offering to your client, and if 5 of them consist of passive fund, 5 of them active funds, 5 of them you don't have to explain, and another 5, maybe 2 or 3 might be underperforming, 2 or 3 might be outperforming, then chances of client dissatisfaction in those scenarios will come down drastically. At that time, you will have a better chance to satisfy those customers, better client retention, getting more word of mouth publicity for your referral opportunities, cross-sell opportunities, increased share of wallet. All these things will happen in success. And maybe because of passives, you might be getting lower economics, lower cost of economics on per unit basis, but it may lead to much higher AUM. Because a satisfied customer will give you much more share of wallet. He will not look for somebody else who will be offering the other side of opportunities.
Okay, thank you. The next question was for Pratik.
One minute, I'll just add to that, especially in terms of, because you spoke of allocation.
Yes.
When you're looking at your allocation also, there's a very thing which we've all been talking about is core satellite. It depends on where your convictions are, right? It's like take the sun and the stars around it, planets, right? If your core, value proposition and your belief is active and you do better in active, put your core as active but balance it out with the passives. I think that would be an ideal, whether that's an 80, 20, 70, 30, 60, 40 mix, that each will depend on all your models. So, that is something you all can work on.
Thanks. That was very helpful. Good. Pratik, the next question was for you. You have about 35 passives. Can you just recommend the top 3 to 4? Because it's a little confusing for us to go through and analyze, so many just from your AMC. So for the next 3 to 5 years, what would you recommend?
So the issue with, being an AMC, sir, is that, we have a lot of different type of customers, investors. We have institutions, we have family offices, we have MFDs, we have retail investors, we have broking clients. So, the AMC business needs to really make sure that we have enough products in the pipeline so that we're able to cater to all of them. And also we have to also continuously innovate to make sure. So, for example, we launched a microcap fund last year, and we've also been the first ones to launch many funds in the industry because, we believe that it's very important to innovate for you to create a very sustainable business model. But in terms of advice, I think maybe we haven't done a very good job of maintaining advice, and internally as well externally, we've always maintained that the Nifty 500 is the fund that we like the most. We are always talking about that with everyone. And that's the one fund I would say that obviously this is not advice. This is just our preferences. So please don't take that advice. But we tend to focus on maybe 3 or 4 funds. Even our entire sales team of about 150, 175 people now, we have 35, but we only talk about 3 or 4 funds. Because as Sir said, the whole point about being in this business is to offer simplicity to our clients. We believe that if we really want to go from, say, 2, 3, 4 crore mutual fund clients to say 10, 15, 20, simplicity is going to be the way towards mass adoption. And we believe that simple products such as these, even the broad-based ones, mid-caps, small caps, are excellent for us for at least the AMCs to, get larger share. And also, just to point out that there'll be a lot more funds coming in, not only from us, but from a lot of other AMCs. But essentially, 80 or 90% of the AUM that you'll see over the next 10 years will happen in the simple funds, which is what I think most people should adopt.
Okay, I think we've completely run out of time. But what I can say is that, this is not any shade like Prem said, but it's a very random saying that I picked up by nobody famous. So it's like first they ignore you, then they kind of laugh at you, then they fight you, and then you win. So I think we are in that fighting stage, and it's a good fight because let's fight it out and see, how we can place this and how you can use this passive space as a very, very, kind of firm in your modeling and that helps you grow your business. I do hope that today's... Ankit,
I have just one point that when we say equity products, be it active or passive, we normally suggest it for long term. And there will be spurts in which they'll underperform. Even the broad-based indices for that matter, so junior Bs also underperformed for a certain period of time. So the spurts of underperformance will come across all the categories. You call it market cap or smart beta. But when we suggest in terms of long-term perspective, I'll just give a number. Like we have momentum base fund, which is 3 years old. And if I just do a 5-year daily rolling returns analysis of momentum in 5-year period, it has beaten Nifty 95% time with an average alpha of 6%. Of course, there can be this 5% instance because ultimately it is equity investments, right? And all of these factors have their own cycle. And I agree to the sir's point that yes, we have to keep things simple, but the entire evolution of these smart beta strategies came into existence because of our fancy to generate alpha.
Yeah, exactly. So I think, Ankit, you had to defend, so definitely point taken. But yeah, market cycles, equities, they always say equity is subject to, market risks. So obviously, you have your cycles. But thank you, all your panelists, and thank you, Cafemutual, for giving us this opportunity to share our thoughts. Thank you so much.